Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so today is September 3rd. We are going to do a market update for Las Vegas real estate market. Before we do this, if you're new to our channel, please subscribe and hit the notification bell because we do these every couple of weeks in Las Vegas, and we do a bunch of other really cool general real estate videos if you're into real estate or want to learn more about real estate.
Right, and please like the video and share the video because it helps other people see the video.
Okay, so before we jump into the numbers here, if you watch our channel regularly, you probably noticed we haven't done a video in a week or so. It's because we took our vacation. Mm-hmm. So we did some traveling and now we're back, and we're going to be doing videos pretty regularly again. Okay, so this is for Las Vegas. This is only for single-family homes in Las Vegas. We're not going to talk about all the other stuff because what we do is every month we stick with the same numbers so we can compare the change. Because that's really what we're doing is we're looking at the change, how the market changes in Las Vegas.
Right, because this is how we see trends by comparing exactly the same sets of data over time.
Okay, so we're going to start with Market Action Index. As you can see here, the Market Action Index, it says it is a slight seller advantage. 38 is the number. 30 to 40 is pretty much where we are or where we have been for the last decade. Now this needle swings throughout the year. It tends to be closer to 70, 80, 90 in the spring, right? And then it drops down into the fall.
Right. So remember, real estate is cyclical. Most people are looking to relocate in the spring. They finish their relocation activity usually the beginning of summer, and then starting with the beginning of summer all the way almost until the very end of the year, the market just keeps petering out.
Yep. And then the other interesting thing is this month to month, this for a couple months, this was dropping by like 10 or 12, but it only dropped by 6. And so that the change in this is almost forward looking. The change in this is kind of interesting that it's starting to it looks like it's going to bottom out around 30 or so.
Right. So a lot of this is that, look, these changes have been so sudden in the last couple of years, right? So the upward thing happened really quickly. The downward thing happened really quickly. And I think that's what's got everybody so upset is the speed at which all these changes have happened. And I think that's what's making people so uncomfortable.
Yeah. I'm just going to read the note at the bottom. You can probably see it there. It says the market has been cooling off a bit in recent weeks as more homes are available and demand is less. We're already going to see prices move lower as a result. Expect the trend to continue, especially if the index falls to buyer zone, okay? And that's something that we track every month. Mm-hmm. But so far, there have been some slight price declines and we're going to go over those in a minute. This is the interesting part. Watch for persistent upturn in Market Action Index to signal prices rising again. Mm-hmm. So what happens every year is the market goes up and down. As far as the buying demand, it's its valley in September, October. So we're in the valley. That's why, but that drop has been exacerbated. You're going to see this on the slides as we go through them. Has been exacerbated because of a lot of weird things happening at once.
Mm-hmm. Right. Look, we all know that last 2 years have been like nothing any of us have ever experienced in our lifetimes, and there's no reason why real estate should be any different.
Okay, we're going to start with median list price. Now, median list price is broken into 4 segments, and it's based on price. So the top, quarter, upper, lower, bottom. And you can see that if you look at the bottom 3 quarters of the market, it's list prices have come down a little bit. But what's really interesting is that the median list price for high-end homes has really taken a nosedive. And this could be because of 2 things, right? Actual people like builders and other people have been reducing prices because maybe they were over exuberant in their list price. Mm-hmm. And then also the change in the properties coming on the market. So if more $1 million houses come on the market and less $2 or $3 million houses on the market, that'll change the median too, right? Because the median is just the middle number of houses.
Yep. Yeah. So look, I think sellers have had their opportunity to sell for more than they could have dreamed of in the spring. And I think the sellers that are coming to market now are going to be more realistic, or they're not going to come to market now. They're going to wait until next spring.
And if you look at this, if you go back to 2021, last year. It dipped last year too.
Mhm.
Like even in the hottest year ever in real estate, the top quarter of the market, you can see that the median list price dropped. It was falling just because it's cyclical, it does it every year. But what happens is because of interest rates and things like that, these cycles are bigger. But these are not long term, these are short term.
They are. I'm going to just touch a little bit on the interest rates. We do know from everybody that's been publicizing this that every point that interest rates go up, it's like a 13% change in that sale price. So it does make a big difference to people who are financing. But we do have a good portion of people who are not using financing, or for whom financing is not the overriding hurdle to overcome.
Yep.
And so they are still in the market. They are still purchasing.
This is very interesting. Median days on market. You can see the trend is that it's starting to increase. This is very cyclical. This goes up and down throughout the year, right? Median days on market is the lowest in the spring. It's the highest in the fall. We're obviously going higher. But if you go back to 2020, we're still way below where we were in 2020 for median days on market. So homes are still selling. Like the market has not completely been destroyed. I think what's getting people is the transition back to a normal market from a hot market. And they're misinterpreting that as a normal market collapsing when it's just the hotness of the market's going away so quickly. We're going back to normal. And in that, there's just a bunch of craziness that happens.
Right. And, like I said before, I think it's the speed at which this is happening that's most distressing to people. And I think that people see the trend and the slope of the trend, and they are anticipating that slope to continue rather than to level out.
Okay, this is, I think, a very interesting one. This is price per square foot. Now, what's interesting about this, this is actually the sale price. This isn't list price. List price is less of a reliable indication. Price per square foot. If you look at the bottom three lines that are almost exactly the same, that's the bottom three quarters of the market. You can see that nice steady stream of going up has basically stopped. Mm-hmm. There's not more appreciation happening. But what's really happening is that top quarter of the market is just substantially less. It went from $400 a square foot to $350. Mm-hmm. That's a substantial change. And when you drop a big number like that, it makes the housing market look like it's changing faster than it is because they're bigger numbers changing, so they change the overall mix, especially if you have less of them, because then the median gets pushed down to median price per square foot gets pushed down even more.
Right. So people are assuming that what's happening in the luxury market is happening in every segment of the market, and that would not be a correct assumption.
That is not a correct assumption. The luxury market is a relative new phenomenon. The normal Las Vegas market is that bottom three quarters. The luxury market's sort of a new thing that's happening here. It is, I think, a growing trend. I think we're going to have more luxury homes. I think Vegas is going to be more like Scottsdale, and then, before it ends up being like California. In Scottsdale, it's just not uncommon to find areas where all the houses are over $1 million. We tend to not have that here. We tend to have average homes, a lot of them. But this idea of luxury homes is sort of new. Now, the big one that's the most important is inventory, the total number of inventory. So we'll go put up the inventory chart now here. Okay, this is what's inventory, and interesting. You can see inventory cyclical. It goes up in the fall, it goes down in the spring. It does this every year. If you look all the way to the left, that is 2019. That was more of a normal market. And you can see we're still well below that, meaning we still have less inventory. Now remember, this is just homes in the city of Las Vegas. This is not condos, townhomes, Henderson, North Las Vegas, surrounding areas, right? You can see the trend line, which is the 7-day average, which is higher, which means that they're still going up. But what's interesting is you see that thing starting to turn. And if you look back at 2021 and 2020, you can see that thing turned and declined. And you can see that it looks like that's where we're going to top off. We're going to top off there at around a little over 5,000. We need to be close to 6,000 to be where we were in 2019. Remember, that's only single-family homes in Las Vegas. So don't go, oh, but I saw a video where there's 12,000 houses on the market. That 12,000 houses on the market is like the MLS. It's not houses, it's every property type. It includes surrounding areas outside of Las Vegas. Okay? So what do you think about this one? This is definitely a bigger increase than we've seen, but those inventory numbers that we've had for the last year or two have been historically ridiculously low.
So look, the last 2 years have been an anomaly for everything, like I said, from housing to supply chain to everybody working from home, which was unheard of, before 2 years ago, and everything else that has happened. So there's no reason to say that, hey, everything else in our lives has been unexpected and unprecedented, but real estate should remain the same. So as everybody's lives are getting back to normal, as there are changes in the market, real estate is participating in that, just like it participated in the one-off for the last 2 years. I think what we're looking at is a market that is returning to normal, to what we are all accustomed to. We're looking at probably lesser fluctuations. We're looking at more consistent markets, more predictable markets, which are healthier markets.
People that watch crypto and the stock market like to watch daily changes. And the problem with daily changes is they don't always match long-term trends. Because we were in a recession in 2020. We've been in a recession for the first 2 quarters of this year, but prices were still going up. And then prices went up in 2020 during that short recession we had, which was the first COVID recession, in 2020. But then the real estate market just took off like crazy. So when you look at long term, because no one can predict what's going to happen short term, what are the long-term factors when you look at all this data, that, and having been doing this for a long time in Las Vegas, that you look forward, like when you look out in the future, what does this tell you? What are the trends? What do we expect to see 5-10 years from now if you just had to paint a picture of what that would look like? Because that's what they want to know. I mean, there are people out there who, they're closing on a house, they just bought a house, they're thinking of buying a house, they're thinking of selling a house, but they may want to do it in a year or two, and they're trying to figure out, they don't want to get caught.
Right.
So how does that work? How do they do that?
Well, so first of all, if you're thinking of buying a house or selling a house, please consider using our services. That was my shameless plug. Okay. Now getting back to this.
But if you're buying a house, it won't be us personally.
No.
Yeah.
No, but so let's get back to kind of the crystal ball that you're asking about. Without a crystal ball, look, short term, I don't know what's going to happen. But long term, I think real estate, barring another black swan event, real estate's going to get back to something resembling what we all expect, right? What we've all experienced throughout the course of our lives, which is real estate appreciating somewhere around 5% a year, and interest rates will at some point return to a new baseline. So if you think that interest rates are going to go back to 3%, I'm sorry, but that ship has sailed. That I do not expect to ever see again in my lifetime. Okay, but if you think that real estate interest rates are going to be somewhere in the 5 to 6% realm going forward, then I think you're in the ballpark. Where are real estate interest rates going to top out? I don't know, but I think that they will continue to go up until the powers that be consider that inflation is pretty much stamped out. And I think that means some pain in the short term. I do think that, like I said, in the long term, somewhere between 5 and 6% wouldn't surprise me, maybe even 6.5%. But in the short term, 7.5% wouldn't surprise me, honestly, because the Fed has stated that they are very interested in stamping out inflation.
I'm going to take the opposite view of that. Historically, every time interest rates have risen by the Fed, it's only happened over an 18-month period. And as soon as the Fed signals easing, the rates drop. And this even happened during the last housing downturn. Rates were falling while the market was falling. So I think it would not be unreasonable. I don't think we're going to get back to 2.75% interest rates. But I don't think it's unreasonable that I think most of what the Fed has said has been priced in, which is why rates have gone up to 5 to 6%, and they basically have stayed there even though the Fed has made some rate increases. And I think as soon as inflation starts tapering off, and then the Fed gets back to trying to get the economy to grow again, I foresee interest rates for the real estate going back to a more normal 3 to 4%,
Okay.
which is what we've seen really for the last decade. I mean, from 2012 to 2019, prevailing rates were 3 to 4%. Here's my other prediction. I predict the people with the under 3% interest rates never sell. I think they borrowed that money so cheap, it would benefit the lender if they would sell, because now they get their money back, and remember that money's out at 2.5% or something. It gives them money back to loan out at a higher rate. And I think that people are crazy to sell their house they bought unless you absolutely have to sell it. I think you're better off keeping it. Right. But I predict that we go back to this normal 4 to 5% appreciation. Interest rates are relatively high over the last decade. Over the course of 30 years, they're still relatively below average. But I say they go back to 3 to 4% in 2 years.
Well,
complete guess.
So I hope you're right.
Okay.
I absolutely hope you're right. But I'm going to stick to my thing, saying that, I think that I think going forward, they're going to be between 5 and 6%, except for the spike as the Fed is trying to get inflation under control.
Okay. Well, we better hope that they can do it in less than 2 years, because it'd be pretty bad if it pretty much wrecked the economy.
I agree with
Worse
that.
than it's being wrecked.
Yeah. I agree with you on that. But I think that they're going to continue to raise interest rates at a pretty rapid pace so that they can bring inflation under control rapidly and then be able to quickly pivot to get the economy going again.
Okay, right. The problem is interest rates is a singular factor. The other problem is the government is spending money like crazy. Printing and spending money on like crazy. So that has to be dealt with.
Well, and I don't expect that will be dealt with, because that's not what government does.
Okay.
They just want to grow and spend our money.
Okay, if you liked the video, please share, subscribe to our channel, leave us a comment, and what else?
Like the video, hit the notification bell, and leave us comments. What do you think? I mean, we've told you what we think. We definitely don't have the same opinion about what interest rates are going to be doing long term. So what do you think interest rates are going to be doing? We're interested in your feedback. And, for those of you that see us out and about town, thank you for saying hello. We appreciate it.
Yeah, two in the last week.
Yes, two
people in the last week.
Yeah, so that's always fun.
Yeah.
And so we look forward to seeing you on YouTube or out and about town. See you next time. Bye.
Bye.